great entrepreneurs and great CEOs who are always thinking and innovating, is if you are going to be in a commodity business, how do you add value? And one way of doing that I'm seeing more and more that I think is interesting is a lot about system integration. Instead of selling panels, you're selling electricity as you're integrating in what's the best tracker I should be using, what's the best inverter. And so you're not just competing on, well, modules are 90 cents a watt. You're getting more outside of that conversation, and it really changes the dynamics you're having. So can you do that in generation sectors? That makes a lot of sense, selling systems instead of a gadget, especially in commodity markets. And then I do think VCs have experience in a lot of times in networking in IT, in the software side in IT, and how are we going to integrate those across? And I think we've heard some really good examples of how that's going to happen.
I agree with that. Bob?
A couple things I'll mention just on what we're looking for and where we think some of the trends are. I'll start by saying I agree with everything Matt said, and I disagree with everything Nettie said on your predictions, just to make it interesting. But next time I'll disagree with you and agree with him. But we're actually swinging more toward, first of all, high gross margins, absolutely. We're not in a 20 to 30% commodity gross margin business. 50 points and above is certainly where we want to live. But we're swinging more towards some of the early stage investment, and because we think it's really underserved. And we think when things swing back, it will do better. But what we're really focused on is capital efficiency. We're not going to invest in something that needs 150 million to build a plant. It's got to be able to get there on 20, 30, 40 million dollars has got to be a really meaningful amount. But we'd like to go early, get in, get a significant ownership percentage early, but then also be in a market where there's real customer pull and not push. We can't make money in our model if a company's going to go 1 million, 3 million, 6 million, 9 million, 12 million, 15 million. It's nice growth, but it's drudgery for us. It's got to have something where there's a real pull and a real, I'll give you an example. I'm looking at a very interesting company, very early stage, still in the university labs, in the water purification, so water, doing desalinization technology, geared strictly to the oil and gas industry and frac water treatment, which is where one of our water investments, Myox, is having great success with the relationships and stuff we were talking about before. Because there's a real pain point there, and they will adopt new technology, and they will go and you can ramp quickly. So we're looking at those sorts of plays and things like that. The other prediction I would make for 2012, by the way, is there's going to be a lot more solar companies that are going to go under this year, a lot. Solyndra was only the tip of the iceberg. It's bloody and it's terrible. And not just in the US, in China as well. I think a lot of those Chinese solar companies are in a heap of trouble. So it's going to be a pretty ugly story. And low cost will drive solar adoption.
Chad?
Thank you. In terms of opportunities in the next few years, I think you're going to see a lot of the secondary venture funds actually be able to capitalize on being able to invest in pennies on the dollar in companies where perhaps they're coming to the end of a fund's life and they need to be ultimately exited, and it's going to give those funds great opportunities because those companies are going to be probably lower risk but also at a lower price at the same time, where in fact the prior funds invested at a higher price with more risk. So you're going to see opportunities there. So if any of you are playing in that space, you're fortunate. Also, some of the private equity players or folks that can see distressed assets, whether it's in biofuels or somewhere in the PV space, there's going to be opportunity. And again, perhaps one of the themes that's going to come up is just where are there opportunities that people can launch businesses that are not really going to require the amount of capital, to ramp a solar business, but more that can even just be bootstrapped. I mean, there are some companies that we're seeing, for instance, in the data center space that have been very capital efficient and have been able to virtually, hold off on taking on additional VC money. And some of their competitors have perhaps, only time will tell, perhaps overcapitalized their businesses that are gonna make, and it's gonna make it harder for the investors and the founding team really to realize probably, their financial dreams from that, whereas some of these other companies that have been much more capital, efficient, disciplined, and bootstrapped it are gonna actually be able to get some favorable returns. And I will say, we've seen that actually with some companies that were acquired 3 or 4 years ago in the smart building space, companies that maybe some of you have heard of, like GridLogix or Richards Zeta, some other companies like that, where the founders were very shrewd with, I think, the point in time where they chose to sell the businesses before they ultimately took on too much capital. So,
What's your perspective on, what do you think in this whole theme park, what is going to be most interesting investment space for you guys?
So I have a slightly different approach. I think if you look at the broad sector theme, there is tremendous technology headroom. If you look at solar, crystalline solar is at 20, 22, 23%. If you have compound semiconductors, maybe they're at 40%. So we have not yet explored the technologies that will help us to get to much higher efficiencies. And that then naturally drives the whole cost curve on a different slope. You look at grid storage, that's a completely untested, the solutions are not there right now. You look at offshore wind power, solutions are not there right now. You look at biofuels, the solutions are not there right now. US had a mandate, there was a requirement to have 1 billion gallons of biofuel that needed to be blended into the gasoline mixture. They got how many gallons? 0. So there is a challenge here. There is a huge amount of technology development that needs to happen, and those are opportunities. Now, it's not enough that you develop the technologies and hope that somebody is going to come and reward you for those. You have to build a layer on top of that that's the right business model. And both have to go together. And I look at solar as an example of an industry that has innovated incredibly rapidly to figure out different business models for how to deploy solar, going from direct sales to leases to community solar and all kinds of different ways, and take the capex part out of the equation and then see how it stacks up and whether it's useful or not. And these kinds of things will become very important from a consumer side. And then if you have the right technology, naturally leads to a cost curve and the gross margin, like Matt was saying. That creates a pull from your end customers, whether they're acquirers or partners or whoever, and that has to be the way to go forward. I think if you optimize and do continuous improvement or incremental benefit type of a project, it's not a venture company. It could still be a viable business, but it's not a venture company. And I think we need to draw the lines on the, and you look 5 years ago, I think very few companies were interested in quote biodegradable or compostable type of goods. But you look at what Coke is doing with their bottles or Pepsi is doing with their stuff. I mean, they are completely bought in, not because of it's green, but it's because it's cheaper. And so those things are happening, but they're not. They did not make a venture company $1 billion, so we don't hear about them.
Bob, you have something?
Yeah, I just wanted to emphasize, I think Rachel touched on it, Nettie touched on it. There's this aura around venture money and raising venture money and startup companies getting venture money. There is a very specific venture model, right? Which if your company, and for those of you that are thinking about raising money, if your company doesn't fit that venture model, don't try to raise venture money, right? Because it's just, there's, my summary is this. I manage with my partners a $400 million fund. I have one job in life. That's to take that $400 million, turn it into something that begins with the letter B. It's $1 billion plus. That's my goal. It's not to save the world. It's not to do something about CO2 or baby seals or something like that. It's to make. To stay employed. To stay employed. There's other reasons, but.
So Bob, we will come, just hold on to this thought. Let me come back to this question and we'll keep you employed because this audience
Well,
over here.
Let me go to my
Sure,
point then,
go ahead.
I'll skip the model. You're overshadowing the moderator here, you're trying to moderate the panel, so. I mean, I know you kind of look similar.
Yeah, we'll last at birth.
Yeah. But I think what you need to do is, if you don't fit the model that Gopal won't let me tell you what it is, then you need to look at things like the strategic investors. And we're doing a lot of this in our portfolio companies now. We're seeing a lot of outside money coming from the Schlumberger's or the Chevron or I'm amazed, GM Ventures started up like 18 months ago and they've done like 12 deals. And I don't know how many of us have done 12 deals in the last 18 months, but you know, it's really surprising how much some of these corporate, how much they've really stepped up. So I think you look at corporate money, look at the angel networks, look at overseas money. I think look at alternative, you know, it's not just US investors that you should look at, and really broaden their horizons. Sometimes some of these clean tech plays resonate better in Latin America or India or China than they do in the US. I'm thinking clean water and things like that. So you have to broaden your horizon. The world is not just Sand Hill Road and Menlo Park in Palo Alto.
No, I think that's a very good point. And let me go back to what Rachel was talking about, I think, and what Matt was talking about, is creating an aspirational product. And Rachel was talking about really doing a commodity business, how to turn it around into a value-added, high gross margin product. I mean, in solar industry, that industry I come from, there are going to be almost $1 trillion assets, solar panels, inverters, trackers, all this $1 trillion of assets will be on the ground in next 2 years time frame. And I would really managing those assets well, who's really maintaining them? Who's really getting data out of them? Who's making sure that the PPA that these companies sign are really profitable or not? Because so far the industry trend has been to just do the land grab. So nobody's monitoring it, nobody's doing the value-added services. I was just counting in this room, there are 18 4x2 lights on that side and 12 on this side where we are sitting. And those 18 lights are doing nothing. And all these lights are fluorescent tube lights with very low efficiency, could have been LED lights, which has become almost like 50% price drop since last 2 years. And they're becoming more affordable, but we are not really creating aspirational products. We are not making our aspirations high enough on not only generation, but on sustainability as well. And that is what I was thinking about. If we have to look at the sustainability versus new generation, there was just an article, there's going to be a new standard. California alone has 160 million chargers, 160 million phone chargers, of different kind we use. And the new standard that will come up from 2012 or 2013 is going to be lighting up 350,000 homes, just saving on chargers. LEDs are saving energy. We don't have to all the time generate energy because we could be saving energy. How many of you, if you have to invest money in generating more energy versus sustaining what you have, making appliances more efficient, how many of you will go for appliances sustainability than generating more energy? Raise your hands. And how many of you will generate more energy versus going for sustainability?
Drill, baby, drill.
I can see the difference is more on the investment, more on sustainability. This is what you guys are telling. This is what I think what Rachel is saying, that there could be a more value-added services and more value-added products. What does our panel think about it? What do you think the next couple of years, next 3 years, would you guys consider a business model or an innovation in sustainability or generation? Nidhi, let's start with you this time.
You know, I think we don't really make a distinction. So we would consider the business on its own merits. I think really both are on the table. Because you need both. If not for the US or, you know, at least least other parts of the world. You look at Japan and Germany, they're both, Germany has already said no to nuclear power. Japan is going to have a very difficult debate and internal discussion about what they do with their nuclear power, and if they don't use nuclear power, what is their source of energy? So I think we shouldn't get caught up in the myopic view from the US. That's not necessarily the opportunity. It's the right place maybe to develop the technologies or work on the ideas, but the markets are not necessarily here. New Zealand is 70% coal renewable energy. They have 1 or 2 coal plants which they're going to shut down in a year or so, 2 years maybe max. So they're going to be 100% hydro and wind and other types of energy. So it's a totally different model. I mean, if you were sitting in the US, you would never imagine somebody could have such a energy mix. So they'll have challenges managing it, but 70% they're already way beyond the minimum requirement for grid disruptions and management. So I would say that for us, it's again the business and really what's the go-to-market, who are the partners, and something that probably is the most important, at least I didn't touch on it, which is the team. I think a lot of these things get fixed if the team is stellar. The business model can be flawed, the product can be flawed, but if the team is stellar, all these things get fixed. And the companies that have done really well the best companies have iterated twice, thrice, and figured out. But they've done it really, really quickly so that they have found their way to the end result. And so that's what I would say.
Matt?
Sure. Well, in the equation that drives the world that I mentioned earlier, there's a generation term and there's an efficiency term. So I agree with Nettie that we look at both sides of the equation. Another point I'd make is that there is a cultural legacy to energy use. And I think the cultural legacy is different in the United States than it is in Europe, than it is in Japan, than it is in India, for example. And I think building a business in a place where the service or technology providing is in harmony with that cultural value will be helpful. Specifically answering your question about energy efficiency, the biggest challenge that we have found in evaluating energy efficiency plans is Americans are in general reluctant to spend any money on energy efficiency. So everyone falls for Gopal's trick. They all want energy efficiency, but if you then ask the question, would you pay $10 a month for energy efficiency, it would just dissipate. And so there's, we looked at residential energy efficiency plays, and over the course of about 15 months, we had seen a few dozen companies in that space. We actually hired a business school student to count them for us. He got up to 108 companies in residential energy management, which led me to believe, it's clearly easy to start a company there. There's a lot of entrepreneurial energy, but most of those companies will not make any money. And we didn't make an investment because of a lack of business model.
So, actually, to give you a real world example, there's a building over in San Ramon. A buddy of mine is an electrical contractor. It's about 80,000 square feet, and he knows the CFO. The CFO is saying, all right, we want to look at trying to save some money through energy efficiency conservation. Well, they're spending about $10,000 a month on electricity and gas. That equates to maybe 12, 13 cents a square foot. In the grand scheme of things, it's not a significant amount of money. It's not going to be very easy to get the CFO and her company to suddenly go and install more energy efficient windows, or perhaps to consider, as excited as we are about the potential for LEDs and the cost curve coming down and there being markets for LEDs on a global basis, that perhaps that building is not the right market. So I think a different way to think about it is not selling energy efficiency, but is there ways in which you can actually achieve energy efficiency and savings, but couple that with perhaps driving greater productivity among employees, where you are able to get, if you suddenly have solutions where you're able to get daylighting, and there are solutions in the whole daylighting space and stuff that probably some of you know more about than I do, where apparently the productivity of employees go up, 30% if they're using daylighting versus fluorescent lighting. Positioning it in a different way. So is it aspirational, or is it something that's actually going to drive greater productivity, and so employee morale goes up, employee retention goes up, ultimately hopefully revenues go up for whatever business is operating in that environment. So that's another way to think about it.
Just humor me for 1 second. So an example of precisely that is Bauer Transportation Services. I'm sure you've all seen their buses around. Many of those that work in Silicon Valley but live in San Francisco use the service. And that's precisely what they did. So you could say it's a bus service, right? That's a real unaspirational way to look at it. But he sells that service to Google as 2 additional hours per employee. And so the fee that he can charge is $100 each way. Google thinks it's a steal if you look at the average salary of a Google employee, and the employees are happy. And so he's completely taking just a very pedestrian category and completely transformed it, and was, to Nettie's point, a great entrepreneur that saw that. Any of us could do that second or third, but it took Bauer to do it first.
Great. This is good discussion. What do you think about it?
Well, getting back to the energy generation versus energy efficiency thing, we by and large don't touch energy generation because most energy generation plays fail the capital efficiency test, right? And you ultimately are building a power plant. Yeah, I'm Japanese. I have to say most and sometimes, and I used to live in Japan, and I always have to do this subtle. I can't say all. I can't be so absolute, but so we put a big focus on technology and energy efficiency. So things like, we've done a couple LED investments. Unfortunately, we didn't make a lot of money there. But, LEDs are one area and solid state lighting one area of interest, and energy efficiency broadly is an area of interest. But at the end of the day, it's got to make economic sense. Or it has to go to markets where it makes economic sense.
It has returned $400 million to $1 billion.
Yeah, well, but it has to. We don't invest because there's subsidies. We don't invest. The minute somebody shows me a chart and says, well, there's no payback time, but we can get all these tax credits and there's a payback time, I pretty much know that the meeting's finished and I'll stay. But it's not going to turn into an investment for us. We don't like subsidy plays. We don't like things where it's going to cost more, but you get to feel good about yourself because you're green, because we don't think that happens. We'd like to see things where it costs less, you make money, you have high margins, you have something that's really unique, and the consumers or the customers are going to want to buy it, and you don't have to try to convince them of it.
Rachel?
Just to add a couple things that I think both, with the caveat that one of my colleagues says, no one says they want to waste, but not very many people, to the point earlier, will pay to not waste. And furthermore, he says, this is Maurice Gunderson, who started Nth Power and then worked with me at CMEA. He said, I'm probably the VC who has lost the most money on energy efficiency because he had invested a lot, and he started investing in the space in the early 90s. So, and I have worked as a facilities engineer for a couple of years, and we would see a lot of things that would save, reduce water use or reduce energy use. And this was, late 90s, early 2000s, so maybe cultures have changed around this, but it was pretty progressive. Intel was tracking global warming gases and looking at these issues then and reporting them out to the public then. And it was very hard. You also have an issue in that space, that often called principal agent, but you can see it in a company of you have to have CapEx spends to have OpEx improvements, and those are different budgets and different motivations. And so I think that's where the business model and whether it's the social dynamics that you're playing off of or the psychology around competition that you're playing off of, there has to be something interesting in it for market adoption. The business model even becomes more important if you're going after, if you're going to take the sustainability or efficiency side of the equation.
Well, thank you very much. We have 15 minutes left and the planned time. And what I really want to be doing now is changing the discussion on a philosophic and a strategic direction to really a very tactical discussion. I want to be asking our panel if any of us go and knock at their door and start to schedule a meeting, and we have a business plan, what they really would like to see. How would they measure the success of our business plan? And I have got 7 metrics, 7 things over here: time to money, the investment size, There's services, software or hardware, operations, CapEx heavy or OpEx heavy, generation or sustainability, or it is a cheaper, greener substitute to existing commodity items. How would you really look at your investment from any of us? Rachel, let's start with you.
I would say that there's one thing on top of all of those, which is back to the team. And in the end, right now I was telling Vin earlier, I feel like I'm lucky to work with these amazing CEOs, and so the bar has been raised of what kind of team and what kind of person I'm gonna work with. And we spend a lot of time with our companies once we're invested in the board seats, and way more than just coming to a board meeting every month or every other month. And so, you know, and that's, I can't explain that in a scientific method of what that means. Because it probably is not the same for each of us of what kind of person comes in and has the attributes that make sense. But then I would say beyond that, I want to really make sure that you're solving a problem and that someone's going to care that you are about the problem you're solving. And then of course you're going to do it better than anyone else and faster than anyone else. And that's, you know, where your technology and the product and your thoughts about how you're going to go to market come into play. But I would say the team doesn't mean you have the team finished, but it just means you're thinking about it, or you can attract them in the future.
So you don't care about any of these 7 things?
It's not that I don't care, but I will, even if all 7 of those are almost perfect, the team would trump all 7.
What is the definition of a perfect number over here? Let me read it for you. Time to money, 1 year, 2 year, 3 years, 10 years. Investment size, a couple of $1 million, a couple of hundreds of millions of dollars. Your services or hardware or software, you care about one of them or you don't care about any of them. Operations, I really mean the team and the whole thing that you answered. And we had an answer on generation versus sustainability, it doesn't matter. Or a cheaper, greener substitute versus a services or hardware or software. So basically you're talking about very specifically on time to money and the investment size.
No, there's actually no hard and fast rule
Okay.
on those. I mean, they're really gonna be, it's like a systems optimization problem. You know,
Okay,
all
all
of
right.
them kind of bucket in and bubble up to different extents. So I don't think I could say, you know, if your time to money is not in 1 year, we're definitely not interested. That's arbitrary. It's kind of the whole pie.
Okay. Let me jump over to Matt. Matt, what do you think?
So Gopal, with all due respect, I think all 7 points are detail.
Yeah.
And each of them, I could answer, it depends on a case-by-case basis. There are really 2 principal points that stand out above all else, and Rachel emphasized one. I've now been doing this on the venture side 7.5 years after having been an entrepreneur for 10 years, and I have come to a Zen-like appreciation of the importance of the team, and it's really the CEO. Each clean tech success that has been out there has had a gravity-bending CEO that could actually create improbable things to happen and almost will them into existence. The other key event is that most of the successful clean tech companies, again defined by an IPO on a US exchange, the team that was present at the Series A played critical roles at the at the post-IPO company. And in Venrock's experience across all sectors, when I asked some of the partner Emeriti what has been a key ingredient to Venrock's greatest outcomes and what role did the founding team play, in 70 to 80% of them, the team that was present and gave the pitch when the first check was written was the team that rang the bell in the NASDAQ. It's that important, is the team. So team can, and it can trump all of that. The second thing though, because even a great team needs to have a great vision, and at Venrock we call it the glimmer of greatness. So that's a clear articulation based on honest entrepreneurial thinking. If everything were to go right for this company, it could be a multi-billion-dollar company. It could truly be a company that changes the world. And so I think it's the team, pursuing an opportunity worthy of their talents. And then the final thing that I add is a much smaller one. It's really, what would be the terms of the investment? At Venrock, we have a predisposition to like to syndicate our investments with other VCs because we believe that having a plurality of opinions around the table is actually really important and actually leads to overall reduction of risk in the startup. And so that's something that's important to us, where if somebody that had already been successful, for example, and came in with a lot of their own money and was looking just for somebody to write a check, that, again, would be difficult for us to participate in. But that's a tertiary component to team and an articulation of the glimmer of greatness.
John?
I mean, I think at this point, I would just echo what Rachel and Matthew have already said. I mean, they've answered the question. I mean, for NGen in terms of, more specifically, I mean, we would want to see companies that are beyond benchtop, beyond even prototype at this stage, more, they have traction with their customers, and there's visibility to ramping revenues and understanding the capital requirements to do that, and ultimately, hopefully it's a business that can either go public or get acquired. And I mean, that's pretty much, the profile, along with what's already been mentioned. I mean, obviously team being critical.
Nate?
So I would add that I think those are all necessary conditions. And in addition, since we play on the early stage technology side also, the uniqueness has to be such that it can survive for the many years that it might take for it to get to market. So you cannot have something that that in the natural course of things, somebody will overtake you in whatever parameter you're trying to optimize. So you have to come in and chew off a pretty big slice of the problem and try to solve it. So you don't want to go from 70% efficiency to 17.5 efficiency, just as an example of photovoltaics. Batteries, if you're doing lithium-ion batteries today, you cannot come in and say, I'll improve my lithium-ion battery density by 25%. That's not enough. You have to do 100% or more, and something like that, because these things take tremendous amount of time to get qualified through the supply chain, and you have to survive that qualification cycle to be able to reach the end. But again, if you have the right CEO or the right team, these come naturally. They're not imposed from outside. I think that's really a quality that you see when you look at the companies that did make it and the ones that did not make it.
So what you're saying is the right team sets the right goal, and therefore the business plan is right, and therefore...
And they choose the right problem to go after.
Bob?
Yeah, first of all, I think we're all in agreement here. I'll do it, my answer quickly. Team, absolutely correct. There's 3 criteria we look for. That's number 1. Number 2, big growing markets that are meaningful, that can sustain a large billion-dollar exit, which is what we're looking for. It's much harder to build a successful company in a market where the incumbents are already experiencing growth, and maybe you're coming into some niche that they're ignoring because they're having a good time in the market, rather than going and trying to scratch market share away from somebody that can just cut their price or bundle their stuff together and cut you out. And then the third thing is really some differentiation that's really attacking a pain point in the industry. So something that's unique, something that's you can sustain differentiation, and something that the customers have a pain point and want to change. I think Matt said this glimmer of, not hope, glimmer of greatness, thank you. That's a good thing, similar thing. Yeah, exactly. But keep hope alive. But there's, the way I think of it is, some people in the room are too young to know what that was a reference to. But the thing we look for is, the question I ask myself is, how is the world going to be different because your company existed that wouldn't have happened if it didn't exist? If all you're doing is supplying a component, but you can do it 20% cheaper, or 40% cheaper, or 50% cheaper than ST Micro, you're not really going to change the world. You're maybe going to make a little margin, or maybe ST Micro is going to cut their stuff, or maybe Samsung's going to lower the price of their phone. You haven't changed the world. So how is the world going to be different? The world is different because of Google. The world is different because of Apple. The world is different because of some of these really, Microsoft. these companies have changed the way we live our lives. They've touched us in some way. If you're not changing the world, you're probably not going to be a billion-dollar company. And so that's a question we look at from the back. And then this stuff is all details, it's all part of the story. Really, there's no criteria around this, except what are the capital needs of the company, and what's the time to exit, and what's the growth. And is that a fit for us as an investor, or if it's a biofuel company and you're going to need $100 million, go talk to Vinod, right? Don't talk to me. But that doesn't mean it's not a great company. It's just not a right fit for us, and that's the fourth criteria.
Well, what I heard over here is I think it's a very sensible thing, which makes a business sense to me, being a businessman for quite a while now. There are two things, there are two risks. Either there's a market risk or there's a technology risk. You can take an existing product in the existing market, scratch a share of the market. Or you can take an existing market and create a niche product, that's what Bob is talking about. And you can create a difference to existing players and make your own niche in that market. Or you can take a existing technology and take it to the new market. So all those combinations are possible. The new markets, the new technology, you are dealing with two risks. So what I heard from you guys is reduce one of those risks and reduce the market risk. Go for differentiation and reduce your risk. Well, this is all great. And I think we all were successful in a few things and we lost a few things. So my last question is a quick round to all of you is, if you have to do it all over again, what would you do different? What difference would you make to your own community? Rachel, let's start with you this time.
List of those companies I would not have invested in.
No, I'm talking at a very very high level, not the laundry list. If you had to do it all over again, what changes would you make in your approach? All right, Nate,
I would say that I would syndicate a lot more than I did, and it's not something that I think VCs are governed by two things. One is fear and the other is greed, and it's one of them is ascendant at any time, and you get drawn by that, and I think it's very important to balance those. So when you come across a company that looks really, really fantastic and you have a chance to really go in and take a big share, you do, not thinking that down the road, it's better to share it and have more people at the table that can help you manage the risks and help in many different ways. And so that's what I would definitely do.
share the risk, syndicate more. That's your one line.
Yeah, because in the end, let's say something is, you might get an exit that's $100 million if you did it all alone, or 200, but if you share, it could be $1 billion. So delta is different.
Matt?
What I've applied in my own practice is I've maintained a higher bar on people. When I first got into some of my earlier investments, I've had management team changes. It's taken time and it's cost money to get the formula right. And once the formula right, our job is so much easier, and it's just a joy to be associated with these companies. So maintain a high bar on people, and if you're an entrepreneur, have that as your motto. So advice to CEOs in the room of growing companies: spend 60% of your time, a majority of your time, on hiring. It'll make your life easier. It'll make or break your company.
John?
I think Nettie already hit on it in terms of, for us, some of the deals we would like to have syndicated more. I mean, that's critical. The other is just a matter of, beyond just the deals that you quickly say no to, is just moving faster, both on some deals that you invest more time than you perhaps should, and then there's some deals that you want to move more quickly on and move more quickly to perhaps look at building a syndicate around. So.
Yeah, we've always syndicated well, so I can't change that one. But I think I do agree with Matt. If I look back at kind of what I've done in both my stints this time and last time in the venture world, not putting a high enough bar on the team is probably falling. I'm a technologist by training. Don't fall in love. You see that's a really cool technology. It was a wrong thing to do, right? Don't fall in love with the technology. It's team, and team. And so yeah, I think I just learned something tonight too. It reminded me of that. The other thing I would say I'd change is, I think too many in the venture world have become too risk averse. And at the end of the day, this is about taking risks and about taking chances and trying to do, and I think we've become too conservative, and I think it's a problem. And that's one thing I would change.
I think realism around timing of what these really are going to take. It doesn't mean that you should invest in things that will take 9 years because you're okay with it, but just understanding from the get-go, what is this really going to take, how long and how much money, and being more realistic about that. And that is the one place where usually you don't listen to the team and kind of trust your gut of we've seen these in the past, how long has it really taken to get to the point where they're a business?
Great. You know, my conclusion of this panel discussion is there are multiple reasons for us to go back home, drive safely, and feel happy about ourselves. But 2 reasons I especially would like to share with you. Number 1, that we had an opportunity of listening to some 5 distinguished people who were here. At least I know a lot more about how to think about investments. The second reason, which is a lot more important, is that each one of them was talking about team, and CEO. All of you have a great reason to feel great about it, because you are all good people, good team, and good CEOs. Well, given that, let's make their life a little bit tougher. Questions?
Go ahead.
It seems like green tech is a horizontal technology, right? That we all coming from our existing industries. I being in PLM, product lifecycle industry, haven't heard reference to that, not tonight, even in recent years. So, seems like as we are borrowed into green tech, with the demise of the industry the last year, seems like we should go back to our core capabilities, our industries, and repackage it differently. Meaning, in other words, the question to panel is, green tech as a buzzword has lost its glitter. Is that correct?
I'll take that. I think yes, it is. I've always thought it was an artificial term. I think it was a proxy for solar and biofuels in the minds of the public. Like we are so, I guess, isolated here in Silicon Valley and all the nuances of clean tech. But as I've kind of traveled around, principally this country and also been to Europe and Asia, that's not a generally understood term. It means solar and biofuels. So my view is that clean tech, the bloom is off the rose in clean tech, and I think we're getting down to businesses that will have to be supported by their financials and their market potential.
Okay. Hi. I heard a lot of discussion here around gross margin, and I just wanted to highlight one aspect of it, that pricing, just how to price your product or price your service, also potentially could play a very important role in the whole gross margin equations. And we do understand that the cost curve, the price curve is determined by the market, by the competitors, but we can also think about another C there, and that's customer. So I just wanted to bring to light like 2 aspects of pricing and how price can be managed in especially emerging technologies. One is value pricing, that instead of pricing competitively, just trying to understand what value your differentiated products bring, and then pricing accordingly. And the second concept that I just throw out to the table is again price segmentation. I heard price points per square feet or per slab, but definitely that's potentially one price point. But price segmentation means that trying to understand the willingness to pay of the different customer segments in the market. So that basically in the whole elasticity curve have multiple points to maximize profit. So I just wanted to bring those to the table. I didn't have a question around it, but if you have any additional thoughts around that, or if you have seen any startups who have implemented these thoughts in their pitch to you, it would be great to hear about that.
That's a great point.
You know, I think especially in, quote, the hardware space, one thing that we look at is this question about commoditization and price compression, and, you know, we're seeing the implications of that. In solar, the LED industry is facing some of those implications, and so how do you, what kind of product do you sell, and how can you maintain price and margin on that product? Because you will inevitably have competitors, and how do you keep this from just being a race to the bottom, where it's the DRAM business, or it's hard disk drives, or some of these other industries. So it's, and you know, there's some companies that think about that, and some that don't. They, you know, there's companies that come and say, well, we're gonna be 30% cheaper, and it's like, well, that's great, and maybe you'll have some good margins for a couple of years, but where are you gonna be 5 or 7 or 10 years?
I just want to thank you for bringing that up, because look, the math on gross margin is pretty simple. It's the difference between price and the cost of the goods sold. And the size of the margin is, you know, one would like to believe is proportional to the value add of the company. The other benefit of big margins is that it affords a lot of room for imperfection in the operations of the company. So that's again why they're important. Otherwise, you know, you require excellence on the execution. But thank you for bringing up the whole notion of price, because, you know, I'm trained as an engineer, and engineers obsess about COGS, right? Cost of goods sold, and you'll spend 3 years engineering a low-cost product, and a single night of beer and pizza will determine the pricing that you're going to go out to. It's like, you know, you should have put at least that many brain cycles into the price of it. A challenge in clean tech, I want to bring it home. A challenge in clean tech is it's difficult to value price something in an industry that does not price for value. And so that requires a changing the structure of how the industry purchases products. And so I think a particularly difficult thing in clean tech is you're largely introducing maybe a new product or service into an existing industry that already has its pricing structure. But that doesn't mean you shouldn't, you know, put a lot more thought into the pricing as you advocated for.
Maybe my comment would be that you can get away with higher prices at the beginning of your life, where you're reaching a segment that is willing to do something for a different reason other than the value they get from the product. But as a company, you have to think about the long term. Where is the majority of your market, and what will they take? So, you know, you look at LED light bulbs, and you know, Philips, etc., was selling them for $80 to $100 a few years ago, maybe 2 years ago. Now, you know, they have to sell it at 10 or 7, right? So, and that's okay. I mean, they made money at 80 or 100, and they'll make money at 10. So I think you cannot. You can use the pricing strategy as a way to ease your way into the market, become more self-sustainable, or, you know, and efficient, and learn and drive it.
John, what do you think about the whole volume in the clean tech? Clean tech is so new right now that we have not hit the volume game. I mean, I know the semiconductor companies, that's my background, we used to sell 15 cents per chip and still making 50% margin, because the technology has advanced so much because of the volume. And if you think about the LED bulbs, or we talk about solar panels, it has not really hit. I mean, if you are able to generate solar energy at 4 cents a watt, that is a coal price. In developing economies like India and China, it's 4 cents a watt. And if you are able to do it at 2 cents a watt, the technology takes it to 2 cents a watt, you can still sell for 4 cents a watt, and you're making 50% margin. I think, what do you think about the whole economics of scale on the volume in certain industries? What do you think could be a cycle time for us to see those kind of technological innovation to really take the price cost down?
Businesses that are dependent on, industries that are dependent on economies of scale are really dangerous places for startups to play in.
Great.
Try competing against Samsung, right, in electronics business, because they know scale.
Hold on, you have one. Yeah. You have one.
Perhaps just
Another point is, Lisa, if you can get to 4 cents a watt, or 4 cents a kilowatt hour, for instance, with solar, that's great, and you'll see much broader adoption, you know, on a global basis, and certainly the percentage of overall energy generation from renewable is gonna go up, but you still have the one challenge with PV, which it only works during the daytime. So how do you solve for that in a grander scale? How does the whole grid storage then factor into that cost per kilowatt hour? So do you double the size of a farm so that you're actually then pumping in enough power to, you know, let's say run this building or something like that, 24/7?
Great, let's go to the next question.
The panel probably has access and insight into global trends and such far better than some of us who have just everyday reading materials. I wanted to ask your opinion on what do you folks think were the top 2 or 3 causes of the collapse of, for instance, the U.S. Solar panel sector? And in particular, if I might point the question towards subsidies one gathers the Chinese government put into its capacity build-out. Would you say that is that a big part of a dumping kind of a scenario that trashed it, like we saw in chips and so on earlier? Or is there something else going on? What are we missing besides the Chinese dumping in the US
Yeah, so I
market?
think, you know, that question will settle itself out. There are lawsuits and counter lawsuits, and we'll figure it out. But fundamentally, China approached solar from a manufacturing perspective. They said, let's be technology conservative, and let's put all our efforts in